Welcome to the Deep Dive. Today we're putting on our TalkTickers hats. We're doing a really special deep dive into a recent earnings call.
That's right. We're dissecting the Simmons First National Corporation's second quarter 2025 earnings conference call. Our mission here is really to extract the most important insights for you, cutting through the noise to deliver that critical knowledge.
Exactly. Going beyond just the press release headlines.
Mm-hmm.
Okay, let's unpack this then. Starting with a snapshot. What were the headline numbers for Simmons First National Corporation's Q2 2025?
Well, overall, the quarter really reflects a company that's pretty pleased with its ongoing trends. They're showing accelerating performance. We're seeing strong indicators of continued progress toward their, frankly, quite ambitious target levels. They seem quite happy.
Accelerating performance. Okay. That sounds promising. So with those headlines set, here's where it gets really interesting. Let's dig into the details of what drove these results and what management is thinking strategically.
Right. So a key highlight, maybe the highlight for the quarter, was Simmons hitting their 3% net interest margin target, their NIM target, and they hit it ahead of schedule. That's a pretty significant point for the quarter.
Wow, 3% IM ahead of schedule. That is impressive. So what's driving this? How do they manage that expansion?
Primarily, it's a repricing story on the asset side. Management noted that approximately, I think it was 46% of their total loan book is fixed rate.
Okay.
And these loans, they just continue to reprice with a consistent spread near 200 basis points, so solid margin there. And on top of that, a high percentage of their new loan production in Q2 was variable rate. Around 75%.
75, wow.
Yeah, which followed about 80% in the prior quarter. So that mix is really helping them.
Okay, so strong asset repricing, lots of new variable rate loans, makes sense. And on the flip side then, what about the deposit base? How are they managing funding costs?
Yeah, good question. On deposits, it's more of a remixing story now. They're shifting funds, transitioning from higher cost deposits to lower cost deposits, which obviously helps margins.
Right.
But management did signal that how did they put it? The air is kind of coming out of that balloon for significant repricing opportunities on the deposit side.
Ah, okay. So that tailwind is fading a bit.
Exactly. The schedule of maturing CDs, certificates of deposit, it indicates lower rates in the coming quarters. So it suggests that repricing opportunity on deposits will fade compared to what they've seen historically. It's getting tougher there.
Okay, understood. Now, we heard about strong loan pipelines and production, but you also mentioned, or they alluded to, some headwinds to overall growth this quarter. What were those factors?
Yeah, the main headwinds were elevated levels of paydowns, particularly in construction loans and also permanent market finance.
Paydowns, okay. Was that expected?
Somewhat, yes. And they framed it as often healthy paydowns. But that, combined with the bank's continued discipline around pricing, well, it tempered the overall growth number.
Pricing discipline meaning they're not chasing volume at any cost.
Precisely. They seem willing to let some deals go if the pricing isn't right, especially in what sounds like a competitive market. Management expects paydowns to remain pretty consistent with the first half of the year, maybe even at a slightly lower level going forward.
So what does this all mean then for the outlook on future loan growth? If paydowns are a factor, are those pipelines actually going to convert?
Well, management highlighted a steady upward drive in their unfunded commitments, which they interpret as setting things up pretty nicely for funded loan growth into the second half of 2025 and maybe even into 2026.
And what about the type of loans?
Good point. They're seeing success at what they call the most leading indicator in their pipeline. And that's showing a growing mix of commercial and industrial loans, C&I. Commercial activity really stood out relative to commercial real estate, CRE, in terms of production and growth this quarter.
Interesting shift towards C&I. That raises an important question, though. What's the picture on credit quality amidst all this?
Yeah, always crucial. The underlying credit picture, they said, remains stable and normalizing. Things are getting back to normal levels.
Well, normalizing, okay. But classifieds ticked up slightly.
They did, slightly. But management stated pretty firmly there's nothing that stands out beyond those two large credits they discussed last quarter. No new systemic issues. They emphasized they look closely at leading indicators like past dues.
Right.
And those showed very good trends quarter over quarter and remain at a, quote, very low aggregate number for the bank. So stable seems the word.
Okay, stable credit. Good to hear.
Yeah.
Now, shifting gears a bit to the outlook, was there any updated guidance for the back half of 2025 during the call?
No, not explicitly. Historically, Simmons only provides annual guidance or that kind of outlook commentary in January.
Ah,
Now, they did bring forward some guidance for Q1 this year, given some specific uncertainties around tariffs and growth. But for Q2, no, they stuck to their usual pattern. No new numbers for the rest of the year.
okay, no formal guidance update. But they did comment on their internal expectations, right? They seemed pretty upbeat.
Oh, absolutely. Yeah, management expressed significant pleasure with the ongoing trends in their business. They stated that the acceleration in their performance improvement and just the pace of it continues to exceed even their own internal expectations.
Exceeding internal expectations. That's strong.
It is. They said they feel pretty confident and maybe as confident as ever about their ability to execute and achieve those long-term target levels they've set out.
Okay, so feeling good internally. Let's zoom out a bit then. Beyond the numbers and the immediate outlook, what's the sort of strategic narrative here? What does this mean for the bank's long-term positioning?
Well, one thing they really underscored was their commitment to expense discipline. They noted significant progress on that over the last few years and talked about having a continuous improvement mindset. Like, they're never really done finding efficiencies.
Right, but this isn't just about cutting costs. It sounds like strategic investment is a big part of their story, too.
Exactly. That's a key point. They are making significant investments back into the business.
In what areas specifically?
Primarily in talent and technology. That came through loud and clear. This includes automation efforts, for instance. And the goal there is twofold. Improve the experience for both their associates and their customers, but also generate capacity.
And that freed up capacity.
And a savings, yeah.
Good.
They're largely redeploying that into talent,
Oh, yeah.
acquiring and developing people. So it's a reallocation, really. And on that talent front, the hiring environment was described as very, very good for them.
Really? In this market?
Apparently so. They've been pleased with their ability to, as they put it, upskill, upgrade, attract, and retain talent across all levels of the business. They seem confident in their employer brand.
What's fascinating here, I think, is how they view the competitive environment, especially with all the recent merger announcements happening in their footprint, like in Texas.
Oh, yeah. They definitely see that as an opportunity. Management views this ongoing market disruption as, well, significant. They're ambitious about cultivating a reputation as a great landing spot for talent and, importantly, customer opportunities that get shaken loose by all this M&A dislocation.
So they're actively trying to poach, basically, or at least be ready.
Let's say they're positioning themselves attractively. They're seeing success in this strategy already and expect the environment for these kinds of opportunities to only get better as consolidation plays out.
Interesting angle. Anything else strategic worth noting?
Just briefly, it's worth remembering the seasonality in parts of their business, particularly agriculture. Simmons has a really deep history there, over 120 years.
Right.
And while that sector faces some headwinds, externally, the bank seems incredibly good about managing it from a credit perspective. They maintain a very selective approach there.
Okay, got it. Deep roots, but careful management. All right, this is the segment where we let our inner hedge fund analyst out for a minute. Let's shift gears. Remember, everyone, this is not financial advice. Seriously, it's about exploring maybe outrageous, but potentially plausible trade ideas based on our deep dive, just to spark your thinking.
Okay, let's have some fun with it. So, considering Simmons' very explicit strategic focus on aggressively pursuing talent and customer opportunities amidst all this industry consolidation, and also considering their consistent ability to reprice those fixed-rate loans effectively, here's a thought for the hypothetical investment committee.
Lay it on us.
The pitch would be something like this. A long position in Simmons First National Corporation, SFNC, paired with a short position in a regional bank, specifically one that has recently announced a merger or maybe is perceived as being ripe for acquisition itself.
Okay, long Simmons, short a competitor undergoing M&A. And any specific flavor for the short?
Yeah, ideally that short position would have significant exposure to commercial real estate, CRE, which, as we heard, Simmons is actively moving away from, focusing more on C&I.
Okay, makes sense. And the rationale for this pairing, what's the core thesis?
Right, so the rationale is you're leveraging Simmons' disciplined approach to loan pricing, number one. Number two, their strategic shift towards those higher quality C&I loans. And number three, maybe most importantly for this trade, their reported success in attracting talent during these disruptive M&A periods. You're basically betting on Simmons' ability to execute, to capture market share, and frankly just outcompete in this disrupted landscape. While other banks, maybe the one you're shorting, are bogged down with complex integration processes or dealing with less desirable loan books like heavy CRE.
Okay, I see the logic. Now, the outrageous part, as we call it, what's the central, maybe unconventional belief this trade really hinges upon?
Well, the really core, maybe slightly outrageous part is the idea that human capital, specifically, the ability to attract and retain top banking talent right now amidst these disruptive M&A cycles, that this will become the defining differentiator for regional bank outperformance over the next, say, 12 to 18 months.
So talent over traditional metrics.
Overshadowing other traditional metrics, yeah. It's a bet that talent acquisition and retention becomes the primary alpha driver, the thing that generates that excess return. That's the edgy part of the thesis.
A bet on people.
Maybe.
So as we wrap up our deep dive today, what stands out to you as the most important takeaway from Simmons' Q2 2025 earnings call?
I think we've seen a bank that's clearly confident in its financial trajectory. They hit that NIM target early, which is big. But beyond that, they're making very specific strategic investments in talent and technology, and they're taking a really proactive stance on leveraging market disruption. Even as, some of those repricing tailwinds on the deposit side start to fade, their focus on assets and talent really shines through.
A proactive stance in a changing environment. That seems key. And just one more crucial reminder. The ideas discussed in our Not Financial Advice segment are purely for illustrative thought experiment purposes only. They should absolutely not be taken as investment recommendations.
Please, always do your own due diligence. We really hope this deep dive has given you a clear, maybe more nuanced picture of Simmons First National Corporation's recent performance and their ongoing strategy.
Definitely. And for your final provocative thought to ponder on your own, if talent acquisition truly becomes the primary battleground for regional banks, as our outrageous trade idea suggested, what other industries out there might see similar shifts, where human capital, rather than just traditional market share or product innovation, becomes the ultimate decisive competitive advantage? Something to think about. Thank you for joining us on the Deep Dive.